Hi, I'm Will Galbraith. I'm a part of the Ray White South Coast Group, and this is your South Coast Snapshot for week 42, 2022. The snapshot's designed to give you a bite-sized breakdown of the real estate market overall, including local, regional and city-based information across Australia. Quick note, all information is sourced from the AFR, leading economists on Twitter and the Sydney Morning Herald. All information is relevant to current buyers, property owners and investors. Home buyers' budgets have been slashed by hundreds of thousands of dollars, new figures show, as rising interest rates squeeze the amount the average Australian can borrow. 5 rate rises since May this year have trimmed the loan size that buyers can qualify for and put downward pressure on house prices. An example, a couple on the average income of $180,000 can now borrow $264,000 less than they could in April, CanStar data shows. A single income earner can borrow $115,000 less than they could earlier in the year. The cut to borrowing power could worsen as interest rates continue to rise. Australia's rental crisis is set to worsen, with the head of the federal government's housing agency warning the housing shortfall could tighten more than expected at the start of the year, as interest rate hikes curb new housing supply and a pickup in overseas migration boosts demand. National Housing Finance and Investment Corporation Chief Executive Nathan Dan Bond said on Monday borrowing costs had risen faster than expected at the start of the year, would reduce construction and curb the agency's February prediction of 550,000 new homes over the next 3 years. The shift from working from home drove more than half the increase in house and rent prices during the pandemic and will likely continue to force up costs and inflation as the shift becomes permanent, according to research from the Federal Reserve Bank of San Francisco. Equity market expectations that the Reserve Bank of Australia will raise the cash rate to 4% or above from the current 2.35% are too bearish, and this has hit the large share price of the 2 larger listed developers more than other stocks, UBS analyst Tom Bordeaux said. But the depth of the current downturn would be limited by low levels of housing supply and a tight rental market, along with low unemployment that would support wages growth and a pickup in inbound foreign migration. Mr. Bordeaux and colleagues say in a new research note, rising inflation due to peak at an annual rate of 7.5% in the December quarter and drop to 3% in 12 months later would also limit the nominal peak to trough decline in housing prices nationally to between 13% and 15%, less than the market consensus of 20%, they also said. We expect a cycle and we know sales have slowed. However, our expectation is for a shorter cycle and a sharper rebound than market expects, he said. Recent average mortgage payments show new borrowers spending about 31.5% of household income on meeting mortgage repayments in the September quarter, and that was likely to increase to 33% by year end, not far below the peak 34% in the late 1980s, when borrowing costs surged by over 18%. The Queensland Premier has been forced to dump a controversial land tax after weeks of damaging headlines culminated in her being abandoned by her fellow state and territory leaders at a dinner at the Lodge on Thursday night. To work effectively, the tax, which would have applied to thousands of interstate landlords who owned investment property in Queensland, needed other states to share personal data of their citizens with the Queensland government. But at the dinner ahead of Friday's National Cabinet meeting in Canberra, New South Wales Premier Dominic Perrottet, who has been a vocal opponent of the tax, said his state would not cooperate. Other state leaders, including Victorian Labor Premier Dan Andrews, made it clear they were not happy about being asked to lift taxes on their own constituents to help Queensland balance its budget. Retail data from the Australian Bureau of Statistics released on Wednesday showed overall consumer spending increased by 0.6% compared with last month and 19.2% compared with August 2021. Household goods retailing rose by 2.6% for the month to hit $6.1 billion. In August 2019, the figure was $4.6 billion. Despite this, retail analysts have warned that spending could slow, particularly on homewares and DIY projects over the next couple of months, as households deal with the continued inflation and more interest rate rises and the end of temporary discounts to the fuel excise. CoreLogic's measure of dwelling values for September, released on Monday, showed a further 1.4% drop across capital city markets. At an annual rate, dwelling values across all capital cities turned negative, slipping 0.7%. Sydney is the epicentre of the price correction. The median house value fell another 2.1% to be down 7% over the past 3 months. Through year to date, the median house value in Sydney is down 9.2%, or by more than $100,000. One of the hardest hit parts of the country has been Sydney's northern beaches, where values are down 14.5%. Melbourne's median house value edged down a further another 1.2% to be down 4.2% over the quarter and by 6.2% this year. And the Reserve Bank has increased official interest rates by 0.25 percentage point to a 9-year high of 2.6%, amid warnings that the United Nations is threatening monetary policy and is also threatening a global recession. The bank increased the official cash rate following its monthly meeting on Tuesday. It was the 6th consecutive increase, the cash rate, which has now been lifted by 2.5 percentage points since the start of May. National home prices are expected to drop 20% overall from their peak, with the bulk of the decline to come next year for most capitals, except Sydney, where the correction has hit harder and earlier, according to the NAB. More builders will fail as rising interest rates increase cost pressures in the sector that has already jumped to account for almost 30% of all company insolvencies, the RBA warns. Looking locally, we are seeing more signs of owners needing to meet market conditions to place themselves into a transaction. Listing stock in our core markets of 2541, 40 and 35 are still strong, with 30 new properties listed in the last week. This is also bolstered with confidence knowing that in the same time frame, 20 properties were sold. Buyer confidence is still strong in our core markets, with purchasers being far more aware of their lending criteria as the market becomes more challenging. We're gearing up for our Ray White South Coast January auction event. 50 properties on one day, January 2023. A perfect time to make use of the summer market and capture those buyers under one umbrella. Want to know more? Reply to this email or give me a call. Looking to make the best use of the current market? If you're either expanding your property portfolio or looking to sell your current property, get in touch today. We'd love to help. I'm Wal Galbraith with the Ray White South Coast Group, and that was your South Coast Snapshot for week 42, 2022. Speak to you next time. Be well.